Hi, I'm Brock.
I'm Jim. I really hope you like our glamour shots.
Before we get started, if you want to stay ahead of the cattle markets, sign up for our free daily briefing at herdadvisor.com. It's delivered right to your inbox every morning, 5-minute read. And when you're ready to dial things in, the easiest way to add $300 per head is timing your sales right and choosing the right sale barn. That's what the Cattle Market Guide helps you do. For just $75 a year, less than taking your wife out to dinner. Check it out at herdadvisor.com. Welcome back to another episode of Cattle Market Guys, your midweek market check for November 19th, 2025. I'm Brock, and I'm joining you from out here in Nebraska, where the frost is setting in and feeder prices are heating up. Jim's with me as always, cowboy hat, coffee cup, and stories older than most of our listeners' pickups. Jim, how's West Texas treating you this week?
Wind's got teeth, Brock, but the calves are fat, fences are straight, and the coffee's strong, so I can't complain too loud.
That's the spirit. All right, let's dive in with our latest market snapshot and take a look at what the numbers are telling us. Looking at the feeder market right now, 500 to 549 pound steers are averaging 393.05 per hundredweight nationwide. That's holding relatively firm compared to last week, even as futures have bounced up. Front and next month feeder cattle futures are both sitting at about 339.90 per hundredweight. What's notable here is the short-term forecast. The national prediction for this weight class is projecting $421.38 for next week, with a steady climb to $448.64 by 4 weeks out. That's about a 14% projected increase over the next month, and that kind of outlook reflects the tightening cattle supply we'll get into later in the show. According to the cattle site, futures have rebounded recently, but gains are being tempered by weak underlying cash trade. So we're in this weird zone where optimism is pushing futures, but the actual cash isn't playing catch up yet. It's like we've got all this momentum on paper, but the real money's still sitting on the sidelines waiting to see what happens next.
Like a horse that'll lope in the pasture but balk at the trailer, got all the potential but won't quite commit.
Exactly. And this gap between expectations and reality is something producers should be watching closely. Futures might look good on paper, but if you're selling this week, you might not realize those optimistic margins yet. The cash market still drives your paycheck, not what some trader in Chicago thinks might happen 3 weeks from now. So keep your eye on what's actually moving at the sale barn, not just what's lighting up the futures board. All right, let's shift gears and look at our first deep dive topic this week. President Trump's tariff rollback on food products, including beef. According to reports from the cattle site and others, the administration just rolled back tariffs on over 200 food products. And yes, beef's on that list. The move was billed as part of an affordability push, trying to cool off grocery price inflation ahead of the holidays. Other products affected include bananas, coffee, and orange juice, but beef's the big one when it comes to our world. From a market standpoint, this move has some ripple effects. Removing import duties on beef could open the door to more foreign beef entering the U.S. market. That means more supply and potentially more price competition, particularly for commodity level cuts. On the flip side, international trading partners like Australia and New Zealand are welcoming the move. They've been pushing for this for years and are now lobbying for a full elimination of any remaining tariffs. That could rekindle some old trade routes, boost diplomatic relationships, and even stabilize availability for packers who've struggled with limited domestic kill volume. But make no mistake, this could put pressure on the U.S. cow-calf producer. Import competition is likely to rise, and it might hit hardest in the utility cow and lean beef sectors. You've lived through more than a few trade shakeups, Jim. This one's trying to be proactive, but it still puts producers in a tight spot. Got a memory that comes to mind?
Oh boy, does it. I'll never forget December of '03. That was the year BSE hit up in Washington State. I had just sold a load of steers that morning for $92 a hundredweight, which was good money back then. Felt like I was finally getting ahead. That afternoon, the news broke. Mad cow confirmed. Within a week, Japan, Korea, the EU, over 50 countries shut their doors to U.S. beef. Prices tanked. I had buddies who couldn't even get bids the next week. Some of them were real leveraged up too, almost lost their ranches over it.
Well, wow, that's a rough memory, Jim, but a critical reminder. The volatility of global trade isn't just keyboard drama. It lands hard on the ranch gate. And while today's rollback is meant to ease consumer costs rather than respond to crisis, the lesson still applies. Global forces can swing domestic profitability in a hurry. You can wake up feeling solid one morning and be scrambling by sundown if the trade winds shift. What this means for folks listening is be mindful of how imported beef could affect regional packer demand. If your local plant starts blending in more overseas beef for ground products or lean trimmings, that could affect cow cull prices and bidding dynamics. Know your buyers, know your channels, and don't assume today's relationships will look the same 6 months from now if cheaper foreign beef starts flooding the system.
Trade policies are like barbed wire. They look simple but can cut deep if you're not careful.
That's well said. All right, topic number 2, the federal investigation into meatpacking giants. Just this week, President Trump called for a formal Department of Justice investigation into alleged price fixing among the major meatpackers. The claim is that the big 4 players, you know the names, might be colluding to manipulate cattle prices downward while keeping beef prices high at the consumer level. And this isn't a new concern. Cattle producers have sounded that alarm for decades. But rarely does endorses mega make it into federal action this fast. The DOJ has officially been directed to look into practices that could amount to collusion, restriction of supply, and unfair price spreads between boxed beef and live cattle. Industry analysts are split. Some say this could disrupt packer confidence and make them reluctant to negotiate in volatile times. Others argue it's high time someone peeled back the curtain. Either way, this is setting up to be a legal and political story with very real consequences. If packers pull back or are hamstrung by fear of regulatory action, we could see further disruption in already fragile market dynamics. The last thing we need right now is packers getting skittish and pulling back even more on cash bids. Does that match what you've seen before, Jim?
Back in '96, we saw near identical smoke. I was at the San Angelo sale barn, hot, dusty, about 30 of us in folding chairs watching the little TV above the scale. News broke that IBP was under subpoena for manipulating markets. Cattle prices had dropped 20% in our area that spring, and the boxed beef cutout was still rising. Everyone was fuming. Felt like we were being played. DOJ raided offices, handed out subpoenas, filed some charges, made big headlines. But in the end, not a whole lot changed. Some fines, some settlements, no real structural shift. Packers got smarter, not necessarily fairer.
And that's the key takeaway. Investigations can validate the anger, but they don't usually fix the system. Still, keeping scrutiny alive might slow bad behavior, at least for a while. For those listening, the short-term implication might mean further tightening in negotiated cash trade. Packers could get cautious or delay aggressive bids while this plays out. Long-term, well, it's a wait and see, but don't expect a silver bullet. Just eyes open and contracts tight. Document everything, know your alternatives, and don't get boxed into a corner because you're assuming someone in Washington is going to ride in and save the day.
A fellow once said, sunlight's the best disinfectant, but in this case, that sun goes down real fast once the press gets tired of it.
Truth right there. So now for our final topic today, market conditions and supply pressure. Specifically, what's going on with packer margins and the underlying cattle supply. JBS, one of the largest processors globally, just reported a drop in net profits, citing challenging beef market conditions in the U.S. The driving issue, a persistent shortage of supply. There simply aren't enough fed cattle coming through the system, and that scarcity is tightening margins for the packers. Even with some, unless there's some strength in futures, the cash market's reluctance and these pinch points downstream are making it costlier to source cattle and harder to protect throughput. That means JBS and other processors may have to change their marketing strategies. Either bid up for available cattle, which they won't do easily, or look to alternatives, possibly increasing imports, which ties back to the earlier tariff rollback conversation. From a producer standpoint, this could create a slow burning advantage. If inventories stay pinched and imports can't scale fast enough to fill the gap, then we might see packers finally pony up on cash trades. But let's not act like it's a clear run. Weak consumer demand or holiday disruptions could dull that edge. You've seen a lot of cycles and processing log jams over the years, Jim. I imagine this one feels pretty familiar.
Oh yeah, tie cattle, that's when the buyers start sweating, but they won't show it till you squeeze a little. I always said, when packers bring donuts to the sale barn, you know they need cattle bad. When they ain't even answering the phone, that's when they think they're holding all the cards.
And right now they're nibbling around the edges, showing interest in futures, but not committing on cash. So just a heads up to our listeners, be patient but informed. If you've got the kind of cattle packers need, well finished, solid weight, efficient delivery, you've got leverage, even Southwood, even if it's quiet leverage. What might also happen here is that retaining ownership through the entire chain could gain value. If you're in a position to partner on grids or post-harvest sorting, there's transparency and traceability are worth more when packers have fewer bodies on the ground to process. Know your alternatives, know your cost of gain, and don't get rushed into weak deals just because someone's trying to pressure you on timing.
And remember, never let them tell you you're the price taker when you're holding the only calves east of the river.
Ha! That's one way to put it, Jim. All right, let's wrap up with some quick thoughts heading into the back end of November. First, keep watching that light steer market. The 500-549 LB average at 393 per hundredweight is sitting below projections, but the 1, 2, 4 week predictions show acceleration, breaching $435 by early December. That could open opportunities if supply stays constrained. Second, exporter countries like Australia and New Zealand are now aggressively courting U.S. buyers following the tariff rollback. That might introduce new players or change buyer strategies in the spot market. Third, be cautious with negotiated trades over the next few weeks. Between holiday downtime, DOJ investigation jitters, and processor margin squeezes, packers could go either way, aggressive or absent. Time your marketing decisions around actual buyer behavior, not just the board. And finally, plan for volatility. Between regulatory concerns, international imports, and supply hurdles, we are not riding a smooth trail into 2026. What's your final thought from your corner, Jim?
Well, Brock, all this talk of packers and prices reminds me of a bumper sticker I saw once. Said, "Cattlemen feed the nation, packers feed themselves." Ain't far from the truth most days. But let me say this, volatility makes folks nervous, but it also makes opportunities. If you've got a good handle on your numbers, clean records, and cattle that'll hang a strong carcass, you're playing with a better hand than you think.
That's the note to end on right there. Stay focused, stay flexible, and stay sharp. Thanks to everyone for tuning in to this week's midweek market check from the Cattle Market Guys. We'll be back for next week's full dive going into December, positioning and holiday demand. For now, keep your ropes coiled and your books balanced.
And remember, in uncertain times, the best insurance is a good neighbor, a sharp pencil, and one extra bale in the barn.
We'll see y'all next time. End of script. That's all for today. Remember to sign up for our free daily briefing at herdadvisor.com, and the easiest way to add $300 per head, timing your sales and choosing the right sale barn, is at herdadvisor.com with the Cattle Market Guide.
Catch you in a couple days.
Okay, see you then.